Thanks everybody for being here. We really appreciate it. I think we get to be on the most interesting panel in the small business track. I'm just going to say that because it's what we're all thinking. Small business lending has been really declining since the savings and loan crisis in the 80s. And if you look at what happened in between 08 and 2010, and then much of the fears about what's going on in today's market, the question really is we see banks pulling back already, and many of the fintechs and other folks who are here on the panel and here at this conference are potentially going to be part of supporting what is really the backbone of our economy through all of this. So I'm Jacob Haar, the one with the hard name, and Community Investment Management, the most generic name you can think of for a company. So, and we're a credit fund that is based in San Francisco and works both in the United States and globally, funding a lot of small business, actually, through different innovative fintech partners. And really excited to be here with this great panel. So as we mentioned, we have Kat, who was one of the early folks at Kabbage, and today is Business Blueprint at Amex, right? Which is the Kabbage brand as it's been brought into Amex.
That is correct. Oh, whoa, that was loud. Sorry, everyone. So yes, in the beginning of the pandemic, American Express bought Kabbage. And so what Kabbage was really known for was lending using persistent data connection and an automated lending algorithm so that they could provide the right amount of capital at the right time to small businesses. And so at the beginning of the pandemic, American Express purchased Kabbage, and now Kabbage, as of January of this year, has been rebranded Business Blueprint. And so what Business Blueprint is, it's a suite of cash flow, it's a suite of financial products that small businesses can use to run their business, all kind of centered on that cash flow tool, a central cash flow analytics tool.
Thanks, Kat. And Todd, you're from Intuit, and you run the lending business there, right? And
I do.
It sounds like you came from Lending Club, where you were there for many years before?
I did. So great to speak with all of you guys. I spent about 6.5 years at Lending Club building the auto lending vertical, and then joined Intuit just about 1.5 years ago. And at Intuit, I lead the commercial offerings, so that's banking, lending, and payments, and soon to be bill pay, and also lead the lending business as the GM. So. Helping small businesses on many different fronts.
That's great. And so you came in when Rania, right, went over to...
Yeah. Yeah. Exactly. Yeah, so Rania Sakar, who's an amazing leader, brought me into Intuit, and now she leads MailChimp, which of course is a company that we bolted on to the Intuit franchise to really help.
Yeah, big shoes to fill, Todd.
I do.
Yeah.
I love it. Yes.
You're good. And Greg, you've been at NAV from nearly the beginning, right?
Nearly the beginning. Excuse me. Yeah, nearly the beginning. Quite a journey. I was actually at Intuit working on QuickBooks, and then I got brought into Intuit by one of the Series A investors.
Yeah, into NAV. And NAV is, yes. Just to make sure folks here understand, as I understand it, you're helping SMBs understand what they can qualify for in terms of financing before they're applying all these different solutions.
Exactly. So we're not a lender. We're a little bit more of like the superstore for SMBs, and we help them understand what they qualify for before they apply by aggregating all the data that these guys are going to look at ahead of applying, and then essentially pre-qualifying and streamlining transactions for financing.
Right. Well, just in terms of this discussion around how SMB lenders are going to support small businesses in the case of a downturn, it'd be great to just start with, well, how are you supporting small businesses today? And with both stress you may see in the market already, as well as imagined headwinds, recession, what we may be headed into, how do you think you will be able to continue to help those businesses in the future? Can maybe Todd, you want to start?
Yeah, no, love it. There's a lot in that question, so I'll try to hit a few points. The place where I would start is really the mission of the company, and so the company's mission at Intuit is to power both SMB and consumers' prosperity. And one of the stats that I love, and part of the reason that I was so compelled to join, was we actually measure the success of small businesses that use our products and have a stated goal of a success rate of 10% higher than the average per the Bureau of Labor and Statistics. So it's really putting our money kind of where our mouth is. And so, you know, Greg talked a little bit about QuickBooks. The main service area of QuickBooks was, of course, accounting. And one of the really interesting parts for how we've evolved the business over time is taking that accounting platform and really putting small businesses in control of their money overall. And so helping small businesses not only prepare their books and be organized, but also, you know, helping them get paid faster. So we have a payments business that actually processes more than $2 trillion worth of invoices. And so what's interesting is most small businesses, you know, really handle those invoices in a manual fashion. And so we know that getting paid is one of the most critical problems to solve for small businesses, and we can speed that up. It usually takes 60 days for most small businesses to get paid, and we can actually facilitate them getting paid almost instantly. So that's one of the dimensions where we're helping small businesses just as a baseline. And then from a banking perspective and kind of transactional perspective, we've got an embedded banking solution. And on the lending side, we help small businesses in many different ways. We have both the combination of a direct lending business where we've got a term loan product that we've evolved over time, and we've also got an invoice financing product so we can really help customers get paid much faster on invoices that are coming in. So when I think about just how we've been helping small businesses, it's putting them in complete control of their money. And we know cash flow is a huge problem for small businesses. It's one of the biggest areas of concern, and it's one of the biggest reasons that small businesses don't survive. And so we feel like we are smack dab in that opportunity to really help them on every dimension. And maybe I should pause and let these guys go, and then we should talk about recession. Otherwise, I'm going to talk for far too long.
We want to come back to how that may change if things, you know, we do see deterioration, or, you know, have we seen it? Will we see it?
Yeah.
Et cetera.
Yeah.
But Kat, can you also talk about the suite of products that you all have, and, you know, what you really feel like are the key value that you're delivering for small business?
Absolutely. And so, like Todd said, cash flow is at the core of the challenges for small businesses. And so right now, what we see with small business owners when we talk to them, we spend a lot of time speaking to them, is they use a lot of disparate products to manage their business. They might have this thing in Excel, they use this program over here, et cetera, et cetera. And so a lot of that reconciliation is manual, it's time consuming, and it's very difficult for them to do. And so what we see a lot with small business owners is they got into the business because they wanted to bake, or they wanted to do the thing, you know, they were really passionate about, and not necessarily spend all of this time, you know, with the numbers and trying to reconcile everything together. Also, it really creates this lack of confidence, and so that's another thing that we hear. You know, we talk to small businesses, and they have accountants and things that manage their books and do taxes, but the big business decisions that they have to make every day, like, that has to come from them. And so things like, can I hire this employee? Like, I want to bring this person on full time. Can I afford to do that? Or like, this new space is opening up New York on the marina. Like, I want to have my ice cream shop in there, but they require this deposit. I don't know that I can afford that, right? And so again, it goes to cash flow and being able to kind of be in that middle, that flow of funds, and allow small businesses to be able to focus on what they enjoy most, what they're most passionate about, is something that has really been our mission. It's been helping small businesses make more confident financial decisions. And so what Business Blueprint is today, it's a variety of different products centered around a free cash flow analytic tool called My Insights, where you can connect both internal products that you use at American Express that you use to run your business, or external products like your bank account, external cards, et cetera, and have all that aggregated and get predictions for what your cash flow might do over time, so that you can stop those gaps before they happen. So there's that, and then it's paired with short-term lending products, or a line of credit product that does 3, 6, 12, 18-month loans. working on adding even more functionality to that, like being able to have someone use their line of credit to directly pay a vendor that they have, like through the American Express system, and a business checking account. And the business checking account's exciting. There's actually, it's been in the news a lot lately for, customers love it. And one of the cool things about that is, American Express customers love their membership rewards. It's being able to convert those MR points that you use across your suite of small business cards into deposits into your business checking account. So all of these things feed in together.
Great. And are you all seeing, in terms of the loan products, are you in the current market, are you pulling back at all?
Well, what I would say is we're in an interesting position of being able to have that strong backing of the underwriting at American Express for all of the different credit card products with that automated persistent data that Kabbage brought to the table. So what I'd say, throughout the cycle, there's always adjustments in the loan terms, but being able to be a little bit more flexible over the different types of loan terms. So which loan terms do we allow certain customers in certain areas to be able to access, and being able to change that pretty quickly so that we're providing right-size capital. And then also being able to offer the other products when if lending is not an option in that particular case.
No, thanks. And Greg, in terms of your business, I was trying to wrap my head around, are you counter-cyclical when folks need money the most? Is that actually when they need you, or is it that volumes decreased and that's actually hard for you in that kind of a phase?
No, so we're aggregating supply and aggregating demand. Demand is dramatically increasing. And what happens in supply, because we sit on about 70 lenders as well as about 100 credit cards, including the most business credit cards, is it's a bit of a next man up model on the supply side. So we work a lot with the American Express team, and they've tightened their underwriting criteria quite a bit since the beginning of the year. And so all of a sudden, people who used to qualify for an American Express loan no longer qualify. So, but for us, then we have another lender who kind of moves into that box. And so the key then for the small business owner, they want really two things. They want to be able to compare their options, which is the challenge that sometimes with closed ecosystem models. And then they want transparency. They want to know exactly, are they going to get approved? Are they going to get declined? And if they get declined, why? And I think that's a real challenge that they're having in this market. You probably have a lot, both years, where you get small businesses applying for financing that don't even have a business checking account. So we will help them understand that that's a qualification that they're going to need to do, or even some who haven't even incorporated, and we help them go through the incorporation process. But that idea of how do I compare my options, and then having transparency under what the qualifications are, right? Is the Fed study continues to come out, the small business loan approval rates continue to stay below 15%. I mean, that's 85% decline rate. That's horribly inefficient, right? And I think that challenges a lot of lending models, especially if you have to throw humans into that system. Now, you guys are doing a lot more automated underwriting, but that tends to tighten the criteria and reduce the risk, as opposed to open the aperture and help get capital to more small businesses. And that's what we try and do by having more lenders available and more of that transparency into what the qualification criteria are.
And do you have that decline rate segmented by banks and, say, non-banks?
We do.
Yeah. So what does it look like?
Non-bank lenders, like I would characterize Amex, it is a bit higher. But it's still in the teens. It's not significantly higher, because even everyone tends to have. Even the non-bank lenders, they tend to have a credit box, right? Their sweet spot is here, and they price to risk in that box, which means, there's a better option for somebody if they're at the high end of that box, because there's usually a cheaper option, or there's a lot of people who don't fit in that box. And so, they kind of optimize, we still see it usually in about the teens in terms of those approval rates, but I don't know if you guys want to share that.
Well, it's interesting also. I mean, there was in 2021, there was a NYU Stern professor who published a report issued by FDIC that essentially looked at the 2008 to 2010, and even I think a few years later, and as the banks were pulling out from small business lending, it was actually the non-banks, and especially the rise of some early fintechs, that not only maintained the same loan volumes that they had prior to the crisis, but in fact made up for the difference of the bank lending that was going away. And so I think that's why this is such a relevant topic, right? Yeah. Is that small business lending, crisis, no crisis, is completely broken at the traditional banks for very good reasons.
Absolutely, yeah.
And a lot of the innovation that we're seeing here, much of which the banks are funding and will continue to fund, but really embeds financing close to the customers, close to the data. I mean, all three of you have mentioned this idea of much of what you're doing is actually offering small businesses insights, right?
Well,
that transparency piece.
Yeah, that transparency into them, and how do you simplify that feedback for them, and then give them actions, right? And so a lot of our business that's counter-cyclical is we have a lot of solutions to help them build their credit qualifications and their financing qualifications. So if they, if they get turned down by CAT and they don't know what else to do, we help them improve their financial profile. And that's a core part of kind of creating ongoing engagement. A little bit like Mint did in the early days back at Intuit, which really giving them those simplified insights around it. But you're right on the bank lending being broken, and most people, like less than 5%, easily, or probably quite a bit less, of loans are SBA-backed loans. The long tail of essentially smaller dollar but high volume of transactions, that's really where the market is completely underserved. And if you're really trying to solve for that segment of the economy, and there's a lot of lip service paid to, it's Small Business Week and all these great things, but there's very little innovation happening to try and solve for that longer tail of small businesses and those smaller dollar loans, because it has to be streamlined, it has to be data driven, and the more it's data driven, actually then you're trying to adjust for risk, and that becomes a real challenge.
Yeah, well Todd, I think that interested in, because Intuit has so much data, so many connections between payroll, QuickBooks, all these various different products. That's great. I mean, it's complex because I assume it's both a blessing and a curse that you are cross-selling so many different products to these companies, which you're also financing. Yeah. Like, how does that weigh into your ability to both support, but also tighten credit, pull the plug on companies? Or, what's going on there? Yeah,
I would say we have over 8 million small businesses that actually manage their business with us and do their accounting with us, and so you can imagine what data and insights that really translates into. It's a true competitive advantage for us. I think that I loved Kat's just comment about confidence and just the fight that I think most small businesses have is managing your money is a massive challenge. And so there's a lot of I would say pausing from a SMB standpoint on taking that action. And so inaction is something that we can really use the data and provide a confidence-inspiring offer, right, within the context of how you're managing your business, so that, and the stat that I would say really sticks out in my own brain is the Fed has done some research that more than a quarter of small businesses that know that they need financing are actually reluctant to even apply. A, because traditional financing is so onerous, and then B, because it's like you're laying your soul bare in front of somebody else to judge, your baby. And so for us, one of the translation of having all of these data and insights is that we can actually proactively offer with confidence a product that will supply capital and do that within the context of how they're managing their business, so that we don't have the effectively the small business owner, staying to the side and just waiting till, the last second when they're nearly about to go out of business and then, reach a point of desperation. So that's really how we're stepping in there. And what's great, and I love the NAV business model is fantastic. We have the combination of both a direct lending business where we have our own capital and those of partners, but we also plug into several other lenders. And so we can provide a combination of not only depth in the credit spectrum, but also products to serve very different needs.
Yeah. And what percent of your user base are you able to do the proactive offers for?
It's almost half.
Almost half.
Yeah, which is amazing. And our approval rates are much higher than the number you quoted.
Well, it makes sense because you're so close to the data.
That's the beauty of the closed ecosystem model, which is great when you're in the ecosystem, right?
Yeah, 100%. So we're trying to get more people to come into the ecosystem, right? Because it benefits your business when you use our products.
Yeah. I mean, what's interesting not only about the 25% of people who are reluctant to apply, but a disproportionate percentage of those folks are women, people of color, who have historically been turned down for loans. And so being close to the data, at least what we've seen with a lot of fintech portfolios, is that they're actually representative of who small businesses are and not representative of the small businesses that get funded. Like if you look at the number of small businesses owned by women, it's over 30%, and yet they're only getting 4% of small business loans from traditional banks. And I'm wondering, Kat, if you have data or insights into also like the types of small businesses that you all are funding, and whether that is, in fact, more representative of who owns the small businesses, not who has traditionally been getting funded.
Well, what I can say is like what has been really helpful about the automated approach is kind of, I don't remember who said it, but speaking about like the big banks and kind of the failure of big banks to be able to fund these small businesses is the fact that it can be a manually intensive process, right? And so when you switch that to an automated process and there's someone can go online, and I've heard the same thing from small business owners when they're applying for a loan. It's like laying your soul bare, right? There's such this fear of this rejection. Being able to apply and get your answer, and hopefully it's a positive one, but noting what you're talking about, Greg, instantly, it's very blind, right? So it's kind of like this blind process of it's not someone sitting there flipping through a stack of papers. And so because of that, you get a much more rich and diverse group of people that you're lending to, because it really comes down to that transactional data, that bank data, that data over time. So I don't have like specific percentage breakdowns for you, but I would say in general, like it is very varied across a large variety of businesses, business size, and business industry. In one of our core tenets is being in business for at least a year, right? So that we have that historical transactional data that we can look at, that our data models can look at to make that type of decision.
And I'm curious that you've talked about transparency, how important it is to really serve the small business owner. Do you also bring that transparency in the loans that you make? Like, do you disclose APR even though you might not be mandated to by law? Are you signatories of the Small Business Borrower Bill of Rights? Like, would love to understand, like, are you actually living up to that standard of transparency?
Yeah, look, I love that. I love that push, and I think the answer is yes. And for us, there's versus a typical monoline lender. There's a lot of power in the ecosystem for us, and we can think about lending, if we're talking about that as a category, as one of the many dimensions that we can serve small businesses. I think what's really exciting about the business that I'm part of is we have very aligned interests. And so the more transparent we can be, for example, and frankly, the better we can price credit so that a customer can thrive, use that credit to their benefit, grow their business, the more products they will end up taking, right? And the more dimensions we can actually help them to solve and run their business over time. So unlike a typical monoline lender where you've got to make that one product meet your profit hurdles, and we can think much more long-term. And I would say for that reason, it's in our benefit to make sure that we're as transparent as possible. And there are parts of the credit spectrum that we certainly can't serve with our existing business model. And that's where we can bring in this combination of both direct lending and marketplace is a great way for us to expand the ability to say yes to many more customers.
But I assume you do have to vet your marketplace participants to make sure you're not bringing predatory actors onto that marketplace.
For sure. For sure. Yeah, we've actually capped APR historically. We've capped APRs, under consumer usury historically.
What rate are you capping it? 36%. And Kat, how has this changed from Kabbage to Amex? Because I know, it's a very different, set of concerns, business model, et cetera. I assume that was a pretty big shift, just culturally and value-wise, to go.
Yeah, it was a really big shift. And that's actually one of the reasons that my hair, well, it was blue. It's a little bit kind of a faded green because, Kabbage was a company that people had so much pride in and were so excited to be a part of and really, really believed in. And so during the acquisition process, it was really important to keep that up. So when we rebranded Kabbage and we went blue, I went blue too. Now it's since ironically faded back kind of into more of a grainy color, but don't read into that. But I'd love to talk a little bit about just transparency really quick. So my bread and butter, where like I like to say I went to art school, not business school. So I actually started Kabbage 10 years ago as a designer. And one of the experiences that I designed was what that loan table looked like. And so when a customer gets qualified, we land them directly on a payment schedule. And they have a little slider, and they have a calendar that shows like every single month, and it shows like this is the principal, this is the fee, this is the total cost, this is what, if you paid it off by this time, this is like what you would save, etc. And so I spent so much time with customers, watching them use the slider, being able to like watch them scroll up and down, asking customers, do you understand what this is? And then when they say yes, say, well, can you explain it to me? And then them go, I actually don't understand what that is. And so being able to continue to iterate and make sure that it is a super, super clear experience for customers.
And Greg, I mean, you have such an interesting view, right? Because you get to see the whole pool of applicants and lenders. Like, love your thoughts on this.
Yeah, I think you're right. Most of the industry, present company excluded, has operated through an absence of transparency, right? And the worst things for a small business owner is apply now to see if you qualify. And there's definitely a heavy underbelly of predatory lending, especially in short-term lending, MCAs, and things that just operate by obfuscating the terms and the criteria. And then there's a whole like underbelly of lead cross-selling and backdooring that exists that I think can be disrupted with more data-driven transparency. And that's really what the small business owners want. You're exactly right. They tend to not qualify or not even apply because they laying their soul bare. But it's a big process for a little return. And to them, they're not, to your point, they don't know what receivables-based financing is or a term loan versus a line of credit. They're looking for money to pay their bills or to fix their truck or to do those things. And so I think there's such a long road ahead to create more transparency. And to your point on those predatory rates, because a lot of the business models are based upon maximizing the rate I can get someone to take and offsetting the risk, to offset the risk. And that's the difference heavily in small business lending versus consumer lending, which has a lot more regulatory oversight and requirements, and small business lending doesn't quite operate that way, of course, present company included.
Well, and, I mean, and just connecting it to this idea of how we're going to support small businesses in a recession. I mean, as you mentioned, far more demand from small businesses today. Capital is scarcer. Power is being accrued on the part of the lenders.
Absolutely.
So, best practice of competitive pressure, not necessarily the main focus right now.
Right. Competition leads to transparency, and that helps the small business owner, and even moving them from, as they improve their financial health profile, moving them from, say, a subprime to a midprime and a midprime to a prime product, right? And helping them know they can do that is critical, because sometimes they don't have the discretion that you do on the consumer side. I'm going to wait till next year to buy a house or wait till next year to buy a car. They need that capital now, and that's where that kind of helping them understand what they qualify for and really be able to compare their options is so foundational.
Yeah, I mean, and as small businesses, are looking to access capital in the future, I mean, there is this real trade-off between access and affordability. Right. Right, and you talked about that. You're tightening. There's customers you'd love to serve, Todd, but you can't. So you put them out in the marketplace, and you see what you can do. But if you're going to cap interest rates at 36%, there are going to be many small businesses that will be declined in every scenario.
Yep. Exactly. Well, there's a little bit of ice cream and vegetables that goes in, right? Which is they have demands. They just want the ice cream. And the vegetables is, what do I have to do to improve my financing options? What do I have to do to qualify for Todd's financing or for Kat's financing? And that's the other part that I think there's a lot of room for, in helping them make smart, simple decisions so that they improve them, but pull them right back into the lending ecosystem.
And Kat, how do you think about that trade-off and being able to? I mean, I know Kabbage in its origin came into the market fairly high cost and actually lowered its pricing over time. Also came in fairly not being transparent and evolved to be more transparent over time too. Like at Amex, I assume the rules of the road are probably different, but would love to understand that. And also, as you think about risk is going up, you're tightening lending. are there just many customers that you can't serve or won't be able to serve in a deteriorating environment? Or are there products that may be higher rate but still can be transparent and responsible to help them?
Yeah, I guess how I think about that is when I look at the landscape of how we're serving small businesses at American Express, like we're primarily like talking right now about the small business funding product, but there's a lot of other products too that help the small businesses, and so there are a variety of small business cards that customers can use, like payment solutions, being able to, the small business account, my insights. So, I mean, what I would say is, like, yes, not all customers are gonna qualify for the funding. The goal is if we can continue to like connect with them and utilize my insights feature, we can monitor a customer's cash flow and be able to let them know, like you know, when they've gotten to that point, right? Like we can then proactively pre-approve someone as we see the health of their business, as we see like them lining up with the approval criteria. Another thing that what I would say that we're focusing on is how do we bring, and I think, Greg, you mentioned a bit of this about like financial literacy, right? How do we bring more financial literacy to our small business owners so that they can understand more about how to survive and how to operate their business during these types of times? And then the other thing that American Express is focused on is really putting a lot of money into a variety of different grants that work with small businesses and also minority-owned businesses as well. So I think it's like spread across a variety of different opportunities where one might not be able to be an option. There are others that can step in and provide some of that cover.
To add on to that, like what we're seeing is people who used to have like a bottom tier of like 2 years time in business and say a 680 FICO and a certain cash flow run rate have all moved those up, and now it's a 720 FICO score and 3+ years time in business. And I think that's where a lot of small business owners don't know why they get declined. Is it my time in business? Is it my FICO score? Is it my debt to income ratio? All of that is not typically what the lender does. To your point on financial literacy, is small business owner just gets the decline. They don't really know, so what do I have to do to improve that over time? What are of all of the attributes you're looking at, what are the ones that are holding me back? Is it my personal credit? Is it my days beyond terms? Or is it by industry? Good luck if you're a liquor store, right? What are there's an absence across the board from lenders on decline reasons.
One thing I would add, and I agree with that. One thing I would add is to build upon Kat's just comment about different solutions for different needs and different customer segments. For example, we can serve a business that has only been around for 3 months. And how can we serve that customer? We've got great insights on their sales behavior, on their expenses. And for us, we can actually serve them not with a term loan, right, like a $30,000, $40,000 term loan, but we can serve them by actually fast tracking their invoices. And so for us, I think the question is, and the evolving product set that we can continue to evolve to serve many different segments. That's really the road that we've been on, so that we can say yes and serve far more customers regardless of where they are in the point of their evolution.
And have either of the two of you that are lending here done surveys of impact of your financing? Like looked if in fact the capital has been productive, i.e. the value that was created was greater than its cost, or extractive, meaning that, and obviously in lending there'll always be both, because all you're doing is magnifying the success or failure of the underlying enterprise, right? But curious as to whether or not you all have data around the impact that you may have actually made on these businesses over time.
Yeah, so I mean, I said this in the beginning, but the factor that we look at is the success rate of the small business overall, and the combination of not only the lending product, but the use of all of the SMB focused products that we've got. I think the statistic that sticks out in my mind is that the 5-year success rate of businesses that use QuickBooks to manage their business is 70%, whereas the static 5-year success rate is somewhere close to 50% across all small businesses.
That's great. Kat, have you looked at the impact on your underlying customers?
So I would say, like, from a qualitative standpoint, the things that we hear a lot of are customers being able to utilize the short-term funding to be able to take advantage of inventory, or to be able to, like, they have this option to be able to buy, X amount of widgets, and they don't have the money to do that, but they would be able to sell it and get, get a profit on that. And so they'll take advantage, they'll use the short-term funding, take advantage. Once they resell the widgets, they'll be able to pay back their line of credit before the actual, length of the loan. So I would say not from I don't know anything offhand from a quantitative standpoint. I'm sure there are many people at American Express that have that info in their heads. I'd say from a qualitative standpoint, the thing that that I hear from customers when I speak with them is the ability for them to be able to exercise on some of those options, or to be able to take that next big step on, like, can I bring this person on full time? Can I open up that new space? And so we do hear that it makes a massive difference in how small businesses operate, and being able to have access to the line even if they aren't utilizing it is important, and also is feels less, I guess, scary than if you're taking out a big chunky loan, right? If you are taking out a short-term loan, a smaller dollar amount that you could pay back whenever and save on fees, and you're only paying for the money that you take, that becomes like a very valuable tool for small businesses to be able to kind of flex in and out through cash flow shortages.
Greg, interested to think about all the small businesses that you're serving and the various different products. So if we go into a tighter credit environment, you mentioned you are seeing lenders tightening. Does that mean that invoice finance products and like ABL becomes more relevant at a time like this, or how does that work?
Like I said, so as Kat tightens her criteria, there's the next lender up, but the cost of capital continues to increase, which doesn't really bode well for the small business owners over time. So those rising rates is a really difficult environment. We saw, the Fed raises the rate 0.5 point. Almost all lenders raise their rates by 2 points, right? And so that just cascades down, like I said, because most small businesses don't have the ability to make it discretionary to wait until rates come back down. They need the capital now, and so there is a bit of a cautionary tale, which I think some of that financial literacy, making smart moves when you do need capital is critical to small businesses. Give them a little bit of vegetables with their ice cream is really critical, and helping them understand, okay, how do they get to something that's cheaper over time. The types of products are really kind of volatile, and you start to get, as you move down the risk spectrum, you get to more and more MCA type cash advances and things that are really tough sometimes for the small businesses to get out of. So it's a tricky time right now, because I think there's a misalignment between lenders who want to offset risk and small businesses who don't have that time to wait. And so hopefully things will settle out and the economy will pick back up and we can get small businesses going again.
And are we seeing loss rates go up? I don't know if you're getting any of that data, or if we should defer to the others in the panel. But
we see some of that, and so yes, but you guys are probably much closer to that, and we do see loss rates going up, which kind of then that's when they adjust the credit box and then they raise the rates.
Yeah, the answer is yes, but it's still not beyond the pre-COVID norms. So elevated, yes, but within the bounds of what you'd expect pre-COVID. That's where we are.
Yeah, agree with Todd.
Okay. Well, great. Thank you, everyone. This is a terrific panel. Please join me in thanking them.
Thank you all.